Well, what's going on YouTube? In this video, we're talking about Grainger, ticker symbol GWW. Year to date, this company's up 24%, 1 year, 42%. So Grainger distributes maintenance, repair, and operating products, services in the United States and really internationally. The company operates through two segments: high touch solutions, endless assortment. It offers safety, security supplies, material handling, storage equipment, pumps, plumbing equipment, cleaning, and maintenance supplies, and amongst many other things. So over here at their website, we can see these are just the categories, some of the other categories that they offer. Assortment of products for you to choose from. If you own really any kind of a business, you can probably find that potential item you're looking for on Grainger. Overall, their financials, and see how their financials are trending and give us an understanding of how they run their business. So over here, revenue, gross profit, net income in order. So our revenue is growing, our gross profit's growing, and so is our net income, which we can see better over here, more of a clear picture of our net income. So good to see all three are trending higher, right? Gross margin was beginning to kind of shrink a little bit, but they've starting to gain some of that back, so that's good. Net margin is starting to increase, which is also fantastic. We can see our revenue and gross profit year over year change, still getting some growing year over year, which is really good to see. And over here, we include our net income as well, and our net income continues to grow, which we can obviously see right here. Return on invested capital, solid, very, very solid up there at 30%, and that also continues to trend in the right direction, which is awesome to see. This is one of those companies that has just a lot more debt than cash. That's totally okay based on how they, that's how they run their business. They operate on minimal cash, but a lot more debt. Net income to free cash flow. I personally like these three bars way more than the rest of them. I like to see more net income than free cash flow. Personally, it's what I like to see, because then I know we're not gaining more from non-operating activities. I like to see that their business itself can perform better than their free cash flow does, I guess is the way I look at it. So our free cash flow is trending higher, consistently higher. Very nice. Our share count dilution is trending lower. Our dividend is trending higher. Our capital expenditure kind of trending lower now, but was trending in a very, very nice direction there for a while. So overall, every single one of these charts to me looks fantastic. If there was one that concerns me, it'd be this one, but based on their history, that's just how they run their business. So there's nothing to complain about there. Um, I mean, these are like picture perfect trends that you kind of want to see in a company. Net margins are growing, gross margins are starting to grow. This is maybe the one trend that you don't want to see, but overall it's right around 40%, still really good. And then they still bring, about 10% down to their bottom line there. So pretty good. Financials look real good over this company. We have three other comparisons. We have FERG, FAST, and URI. We have done FAST already and compared FAST with GWW, and I believe two or maybe three other companies, I don't remember. But over here we can look. There's zero red flags on this company. There's nothing to look further into to see, oh, why is that like that, for at least for the things that I look for, right? So we have our market cap and our revenue on the right-hand side. We've got our revenues, gross profit, net income comparison to all other companies, with Grainger here on the left-hand side. You can see Ferguson here is the leader of the pack by a good clip in terms of revenue. 5-year growth rate, unfortunately, this one's throwing the whole graph off, but we can still see right here our analyst forecast growth rate, 6.78. This is where that Ferguson's throwing everything off at 237% growth on the EPS side of things. And then the other two companies here, we're sitting at that high single digit growers across the board, really. Gross margin, fantastic gross margin. Operating margin is acceptable for sure. Profit margin, a little low, but still pretty good. Return free cash flow, we're sitting at $1.3 billion. Return on invested capital, really good. And our PE, right in line with everybody else, really. I mean, we're in the middle of the pack, I would call it, 20 PE roughly. So, I mean, again, this is just, this looks really good so far. I mean, there's nothing here to like look deeper into. These, I mean, if you wanted to, you could look at Ferguson and figure out why, they've got a significantly larger market or revenue stream than what the rest of the competition does. But look at their gross profit. I mean, you got Grainger not far from behind you. You got $16 billion in revenue. You got $29 billion in revenue. So almost Ferguson's almost double than what Grainger is, and our gross profit is 60% of what Ferguson's profit is, right? Maybe even closer to 70%. So, I mean, in my opinion, right there is enough for me to not want to look into this company because just because they're producing more revenue doesn't mean they're a better company to invest into. Obviously, they're not doing a good job. They definitely could, but maybe that's something to look into. Maybe there's a company that, like, okay, if they're producing that much revenue, maybe let's figure out where all that money's going to by the time it gets to gross profit. Maybe there's a reason, maybe it's temporary, maybe it's growth, maybe they've got something going on. So I guess I shouldn't completely shun out Ferguson because maybe that is a good company to look into further to understand, why such a big difference when the competition seems to do a much better job in terms of revenue to gross profit. And same thing with net income. It's identical in net income. So I mean, that's another one of those things like just because you make more money doesn't make you a better company, in my opinion. Peter Lynch valuation. Peter Lynch gives this company a value of $397.30 per share. Multiples comparison, we're sitting at $629.20 per share, our manual PE, 23 years before we earn our current market cap of 34, almost $35 billion, $34.6 billion. So not terrible. We are fairly valued on that. Price to book, we are sitting below our 5-year average on our price to book. Our PEG ratio, this is not a growth company, so I don't ever expect to see a high PEG, or well, in this case, a low PEG. We always usually see high PEGs on more stable, mature companies. So not too concerned, even though that is actually kind of barely overvalued. Graham's valuation, I gave them a 2 because they are a stable, mature company, been around since 1927. We have a $969.55 per share. Dividend discount model gives them $697.68 per share. We have our DCF calculator. I gave them a 20% free cash flow growth rate. Analysts have them at 30%. Their history is 8.9%. So I just kind of went right down the middle between analysts and their history and gave them a 20% growth rate. That gives them a discounted cash flow price per share of $658.33. Down here at Rule 72, we got our EPS, our current PE. We have 3 different EPS growth rates from 3 different sources. The average growth rate is 21.45. 21.45 goes into 72, 3.36 times. 3.36 goes into 10 years, 2.98 times. So 2.98 times is how many times we get to double our EPS. So we're going to double it once, twice, and 3 times. I did not double it that many times. I just gave them a 100, and I just typed that in there, and that gives them a fair value at that rate of 1,072.72. So the reason why I did that is because what are the odds that this company is going to grow at a 20% rate like that? Probably very slim. So if we were to adjust this, let's just change this real quick. So when I change these two to 10%, it gives us a double of 1.5, which is probably way more correct. So that would give us closer to that future EPS of like 100 per share, right? So that gives them a fair value of $522.72. Now we're going to change this back to the way we just had it because that's what is forecasted for the next foreseeable future for, I believe, this next 5 years. So we're going to take those analyst growth rates and put them back to where they were and continue moving on. But that's just for you to see that if this company decides to slow down, what Rule 72 in this calculator would show. Over here at the summary of all of our valuations, all our calculators together, we have a current price on this company of $691.84 per share. Our fair market value of the average of all of our calculations that we did, which is all 6 of them that has a number tied to it. We have 1, 2, 3, 4, 5, 6. Gives us $747.98. 30% margin of safety in this company, $523.59. Good luck with that. And then an analyst price target of this company is $725.20. So we're within spitting distance of where analysts have this valued at as well. So that's always something that to throw in there to make sure, not make sure, but just kind of compare, see where you're at compared to where they're at, type of deal. Can't hurt. All right, so over here at the stock chart on Grainger, in the last 3.5 years, this company is just in this very consistent uptrend here. Rightfully so. I mean, if you look at their financials and how they're growing on every side of the aspect, their shares are decreasing, they're increasing their dividend payout and everything. They're free cash flow positive consistently. They've got good things going for them financially, right? So there's reason for this company to be trending the way it's trending. I think this is a company that could be overbought because of the overall market conditions. There's a chance that maybe this recent sell-off has a lot to do with maybe investors are pulling out of these safe companies and sitting in the sidelines on cash, waiting kind of for start to trickle into some of these more speculative plays or high growth companies. Instead of sitting in these safe companies such as Grainger and some of all these other Coca-Cola, other companies that are recession resistant, such as Grainger here, as we can obviously see that is a thing. So that's my guess is on Grainger. Not a guess, but I would think that Grainger has the pullback potential still down to the bottom of this trend line here, maybe mid 600s. If it comes back down to this trend line, I think absolutely a buying opportunity on Grainger here. I don't think this thing's coming down to $530 per share. If it does, I think that is a fantastic buying opportunity on Grainger, and that is something that should be bought for sure. I think even pull back to this bottom of this trend line here is a fantastic buying opportunity and should be bought, and even could be potentially bought a little bit here, and maybe this thing continues higher. Probably not much higher than where the previous highs were. Obviously, we just valued this thing at about 740-ish dollars per share. So it's got about $50-$60 worth of room. So basically a potential retest of this range, and then maybe a consolidation or maybe financials start turning around and become a lot better. But in the meantime, with the numbers we have right now, I think I'd like to see this thing pull back to this trend line, and I think that would be a fantastic buying opportunity on this company. And honestly, this company to me looks perfect, like picture perfect in financials and every aspect of how it's making its money, how it's running its business. It's just everything you'd want to ask for in a company, in my opinion. So a very solid company. I will be keeping an eye on this company if it pulls back to that range. Like I said, around $650 per share, I will be a buyer. But that is it on Grainger. If you liked this video, drop a like. If you also like this video, subscribe and comment. Let me know what you thought of this video. And we'll be back later with another stock analysis video.